Thank you. Well, I've been told that we're running short in time, so I'll go straight into it. And welcome joining us online, Joe. I understand that you're in Macau. Right, so I'm going to turn to the first question. I'm going to turn it over to Hester. Okay, so people have been talking about a funding drought, right? A funding winter. I mean, since with your position, you are looking at the big money flow and pulling strings at the top level. What are we really looking at here? Are we simply looking at a winter drought or capital drought, funding winter, somebody call it a funding winter, or are we looking at something bigger?
Well, thanks, Gary, for your question. And so I represent the International Finance Corporation. For those who don't know us, we're part of the World Bank Group. So we're a development finance entity, and we provide investment to emerging markets and globally. And in Asia, so we just had our annual meetings in Washington, D.C. with the IMF. And, of course, the news coming out of there was quite grim from a global economic perspective. The headwinds are quite strong, and they're coming from many different directions. I think inflation, geopolitical tensions, trade challenges and supply chain challenges, compounded by the sort of the aftermath of COVID, and a variety of other, sort of climate-generated difficulties that we're going to see even more of going forward. Those are all combining to create a really, really tough situation in financial markets. And traditionally, actually, when you get this combination of low global confidence with kind of aggressive tightening from the Fed, what happens for financial markets in the emerging markets in particular is you get a financial crisis. So this could be something that is, as you said, much bigger than just a funding drought. We could be entering a period of recession globally. And of course, this will have impacts on the funding environment for startups and entrepreneurs across the region. We have a particular focus on the emerging markets, of course. And what we're seeing is that there is retrenchment. The big money from the US, from Europe, is pulling out. There's money that's shifting from China towards the markets in India and Southeast Asia. But I think overall, this is going to impact primarily sort of more mature companies. And there is, as I think the presenter from KPMG said during her presentation, there's a lot of dry powder for earlier stage companies that are in the region that are showing strong fundamentals. So it's kind of a mixed picture. It's tilted towards the downside, though.
Interesting. So it's not all doom and gloom. There's still some optimism out there. What about you, Joe? What are you seeing on the ground? I know you travel around Asia a lot as well, and you must be having some interesting observations on the ground.
Hi, everyone. Obviously, right now, we're going through a difficult time, right, for corporates, for investors, for startups. I do think that, this is a point in time, in the last 20 years where we've seen economies around the world all suffering at the same time, right? I think in the past, we've seen, maybe something going on in the US, but, China was okay, or maybe something going on in Europe, but, the US economy was quite strong. So I think that, it was actually, we had a good, run, right, of a rather benign environment. And I think right now is a big test for everyone. In these environments, obviously money actually go towards less risky assets, right? And so I do think that we'll see funding becoming more difficult. I do think that quality is very important. And I do think that, the investors group that are most conservative these days are going to be the ones who have not seen these downturns, which I think is a lot of new capital in the last 5-6 years have really not seen, a drought, as you call it, as severe as the one we're seeing right now. I think those are the ones that are going to be most risk averse. The silver lining, if there is one, is that quality will become more important. And I think that the vintages of investors that are investing right now may actually see outsized returns given depressed valuations, given perhaps a little bit more selection that they can actually, rely on. So I do think that, for the brave and for the through cycle thinkers, right now is actually not a bad time to be in the market.
Thank you, Joe. Interesting. So somewhat consistent with what Hester shared with us. So it's not all doom and gloom, but at the same time, there's still a bit of silver lining as long as we pick the right quality or being able to identify the right quality. Before I move on to the next question, Louisa, would you have anything to share or add to that question?
Yeah, I know. I think the two panelists covered, the macro headwinds very, very well. I want to focus a little bit on the silver lining piece because, if you're just looking at kind of VC funds fundraise in the last 2 years, actually 2021 was a record year for VC funds. So I think just looking at U.S. VC funds, they closed over $150 billion. And I think everyone had the expectation that this year, this is going to kind of come down quite a bit. But I think just looking at data as of kind of July, we actually, the amount of VC funds closing fundraise is actually even higher than last year. I think what that means is there truly is a lot of dry powder sitting on the sideline. So, as these macro constraints remain, I think something not to forget about is there is actually a lot of supply just waiting to be deployed. If you think about kind of the deployment cycle for our VC fund, it's usually 4 to 5 years. A lot of these funds are getting into the time where they're looking to deploy and patiently waiting for the right target. So, if we're going to focus on the positive, I think that's one to take away from.
Thank you, Louisa. I think that's a very interesting comment, especially you represent the VC community. So you mentioned that there's a lot of dry powder sitting on the sidelines. So for those that are looking for fundraising or planning to do fundraising exercise in the near future, we have a couple of other panel speakers have shared that quality is important. So to you, what good quality looks like from a startup business?
Yeah, sure. I think this is a feedback that's echoed across the investor community, which is being a lot more disciplined and focusing on startups that are of good quality. So, how do we think about what's kind of good quality? I think actually in good markets, if you are a startup founder, there's actually a lot of distractions, right? Like, you have to fundraise probably once to twice a year. You're constantly fending off investor inbound interest. So there's actually a lot of distractions for you to, focus on the core business. I think as a founder, how to focus on quality really is going back to the basics. So taking a look at your business, are there, operational improvements you can make that improves your unit economics? Going back and seeing are you truly offering something that has product market fit, listening to your customers, improving metrics like customer retention. These are really, really important things that investors are focusing a lot more on as they look to select the winners for their next deployment. So I think those are the key things we want to see. And at the same time, we also really appreciate startups that's taking this opportunity to think about things like inorganic growth. If they were in a position where they are sitting on a healthy cash position, to think about what are other ways to grow in this rather limited resource environment. I think those are also things that investors are looking out for.
Thank you, Louisa. Hester, would you have anything to add?
No, I think just from an investor perspective, what we're looking for, of course, is, as both speakers mentioned, is the quality business with good fundamentals, that something that has good management and good prospects over the long term. We are hoping that the investee companies that we're focusing on right now are hanging on to the cash that they have, that they're, again, focused on the fundamentals, that they're looking at value addition in places like loyal customer retention, and then thinking about things like reskilling or upskilling for the growth areas in the future. And some of the companies that we invest in, for example, in the e-commerce space, they're going to be doing embedded finance in the future, most likely, so that they need to acquire those skills and maybe try to right size if they've been doing a lot of aggressive hiring over the last year or so in the boom times, and then maybe renegotiating some contracts and trying to find ways of saving money and retaining cash for better times.
Thank you, Hester. So it sounds like the advice from our two panel speakers on the stage is that it's no longer an environment where entrepreneurs or founders could simply be simply focusing on growing the top line, improving sales skills, but at the same time they need to start looking internally and improve their operational efficiency and so on and so forth. All right. Joe, and I'm going to pass it over to you. So the next question is, we have, with the low interest environment that we have been seeing for the last decade, so it seems like for many startups, virtually all of them have very much adopted the raise and burn kind of strategy. So, given the current environment that we're looking at, what would be the right strategy or the more sustainable strategy that you see on the ground, and whether they are anything that could be more widely adopted by the startup community?
It's an excellent question. I think that right now, when I talk to, more like the unicorns, right, who have been actually burning cash at a very quick pace, right? Everyone's trying to conserve cash because no one actually wants to fundraise in this environment, especially no one wants to do the down round, right? So you're seeing a lot of conservation of cash positions right now, right, across the industry. You're seeing a lot of people who are trying to stretch out, right, for, maybe wait this out a little bit more. Look, I think that's a strategy if you are quite mature, right, and you actually have, kind of a cash burn that, may be running out in 12 to 18 months, right? I think that's I'm very sympathetic, right? Like, we'll understand why we're doing that. However, if you think about, venture capital as an asset class and what investors are looking for, look, I think at the end of the day, of course, it is a stage gate process. Of course, we're looking at, fundraising, going to the next milestone, and then fundraise again. I think there's no getting around that, right? I mean, you're not going to raise around and then, this could be your perpetual capital, right? No one is actually going to fund you for that, and no one's going to reward you for that kind of growth, right? You're still going for growth, right? But I guess, what is a little bit out of vogue right now, right, is where you are heavily reliant on things like, heavy marketing, right? That is actually fueling customer acquisition, right? You're looking at things like perhaps, right, you're trying to make sure that your proof of concept is really around, having a sustainable, profitable, kind of, point before you scale. So I think there are things that we are doing right now to, in some ways, either mitigate or maybe de-risk a little bit, right, the fast burn, right? But I think that mentality of it's still a stage gate, right? You're still running through your cash into the next round, right? And then you're proving, right, that you can actually scale, and then you get rewarded for the next round in both valuation bumps as well as cash infusion. I don't think that needs to change, or you can get away with that, right? But the ways you do it, the time frame, how you think about it, and perhaps a bit more tactical around how you want to reassure to investors that you're on track to something that is going to be sustainable, is going to be at a premium right now.
Thank you, Joe. What about you, Louisa? You represent the VC community. What's your view on that subject?
I think it's, all the points we've already talked about, which is, focusing on quality, focusing on kind of sustaining cash. I think I just want to maybe emphasize a little bit more on, I think we've talked so much about like conserving cash, but actually I want to focus a bit more on the point of like the being opportunistically focusing on growth as well. Because, I think if we're looking to a lot of Hong Kong startups, actually the nature of actually a lot of Hong Kong startups is that some of them are actually profitable, right? Like, I think majority of Hong Kong startups are the ones that usually runs in a very efficient way. They have a, very profitable business model, but maybe what some of them lack is that massive TAM, like that massive market opportunity, or it could be something that like they're not focusing entirely on how to like use more technology, build more intelligence into their business. So I think for this type of startups, it's a really good time to think about if you have a profitable business, what can you do with that, right? Like I've actually recently in the market seen quite a few cases where you have Series A or even bootstrap startups acquiring assets from like much bigger competitors, or even these unicorn companies, because I think nature of startups are very different. So there are some companies that's running business models that's a lot more capital intensive, and in this type of environment, they tend to struggle a little bit more. So if you're a startup that has this type of profile, it's a really good time to look to your competitors, look upstream, downstream, reach out, have a conversation, whether it's a merger, acquisition, or just acquiring a piece of asset. Like you see a really awesome piece of like SaaS platform, instead of spending all that money to build it yourself, it's a good time to reach out and see if you can just acquire a piece of asset. So I think that's something every startup can keep in mind as well, while you're staying very cautious of your own cash situation.
Thank you, Louisa. Sounds like you have seen some very interesting thing on the ground. You're seeing maturing startups maturing too early, not growing fast enough. All right, we only have a few minutes left. Since we are covering a very interesting topic, it's about funding, and to many startups, I suppose there will be some questions from the ground that would be that you would like to ask our panel speakers, whether it's Joe on screen or on stage. So a couple of questions on the ground. Any question? No, we're good? Okay. So I guess that's all the time that we have, and thank you very much, Hester, Louisa, and thank you, Joe, joining us from Macau, and I'll pass it back to the organizer.